Hey everyone, welcome to Trading Contrarian. If this is your first time on the channel, make sure you click the subscribe button so you get alerts on when I post videos like this. Today I want to talk about the big day for the economy tomorrow, as the FOMC and Jerome Powell, the Fed chairman of the United States, will announce their decision on cutting interest rates. It is believed by a lot of analysts and market participants that a 25-point basis cut is already priced into the market. It's what it's expected, but as you can see down here, these are the probabilities. There are some industry experts and analysts, including the president himself, who would prefer further rate cuts more than 25 basis points. And you can see as we get closer to tomorrow, there is a lot of uncertainty of what that decision will be. On my last video, I want to talk about oil. Oil saw one of the biggest surges on Monday. The contract soared as much as 19%. That is the biggest jump in history after a series of attacks on the Saudi heart of the oil industry disrupted its production. However, today, the energy minister, Prince Abdulaziz bin Salman, said that the kingdom's oil supply will be back online by the end of September, and that is a lot sooner than the market expected. So oil dropped today about 5% and gave up some of those gains from the day before. And my point in bringing this all up is just to show you just how fragile everything is going into this decision. This is now the only event that happened last night in the repo market. And if you don't know what the repo market is, I'm about to tell you. The repo market is when one party lends out cash in exchange for roughly equivalent of value of securities, often treasury notes. This market exists to allow companies that own lots of securities but are short on cash to cheaply borrow money, and it allows parties with a lot of cash to earn a small return while taking little risk because they hold a security for collateral. A key feature is that the cash borrower agrees to repurchase those securities at a later date, often as soon as the next day, for a slightly higher price. So somewhat of an IOU, a very short-term one. That difference in price determines the repo rate. Repo rates can rise for a number of reasons, but they do so particularly when there is a shortage of cash in the system, making borrowers willing to pay more to get their hands on it. So last night, this rate broke out to as high as 5%. And what some experts suggest is that the Fed has somewhat lost control of the situation. Repo rates are normally aligned closely to the Federal Reserve Fund rate, which currently sits between 2 to 2.25% and is similarly a short-term borrowing rate between financial institutions. But the rate on repos briefly and unexpectedly surged Monday past 5% and then soared again Tuesday, according to Refinitiv, raising the possibility of a funding crunch and catching traders off guard. So yeah, that's what happened. No one really knows precisely what happened, but traders pointed to a number of things happening at once that might have caused security lenders to suddenly be willing to pay more to get their hands on cash. For one, Monday marked the deadline for companies to submit their quarterly federal tax payments. That sucked cash out of vehicles like money market funds as companies transferred it from their accounts to the Treasury. Monday was also the day the Treasury Department auctioned off of 78 billion in debt were scheduled to settle, meaning that 78 billion in cash was turned into securities. Together, the factors could have caused a shortage in cash in the system, causing a huge spike in the overnight rates, quoted Donald DeGaloma, managing director and head of Treasury trading at Seaport Global Holdings, in an email. Another theory: for whatever reason, traders were unprepared for what should have been an anticipated crunch in cash. Term repo rates showed no bump earlier this month to bridge over the obvious one-day pressure that were due on Monday, wrote Jim Vogel, an interest rate strategist at FTNN. So I bring this up again because I showed you that probability. We've talked about oil. We know about the trade war, and there's just a lot of uncertainty in a lot of places, and this leads me to believe this market is very fragile going into this decision. So I think tomorrow there will be a lot of volatility. I don't know what to expect. If anyone tells you they do, they're lying to you. But one thing I do want to show you is on July 31st, the last time the Fed announced a 25-point basis cut, the TLT, this is it tracks bond pricing on the 20-year. This thing surged all the way up to the high, almost, you can see $149. And this is not something that should move like this, but it did. Along with that, SLV, which is, you know, the silver ETF, right around the same time, we can see, right? Safe haven assets just started to spike around the same time. When you look at GLD, which is the gold ETF, well, this thing's been surging before that, but you can see when this happened around the same time, it surged again. So what will happen tomorrow? There is a lot at stake as far as which direction we're going to go in the market. We've been seeing a rotation from growth stocks to a lot of value stocks, but that is a good sign, as investors are still willing to drive this market higher. Let's look at the SPY. We are at all-time highs, and we're just near the top. So will this market continue to rise? That will be very dependent on tomorrow's decision. One of the things I am worried about, or I would say is well, there's risk in it, is not necessarily all these things, but the reaction after this. As I mentioned, Trump has been very vocal about Jerome Powell, and he wants the guy fired pretty much. If you follow Trump on Twitter, he has not been happy with none of the decisions the Fed has made. He would prefer interest rates closer to 0% or negative interest rates like other countries' sovereign debt. And if you're wondering why some would pay for a bond that has zero interest, well, when interest rates go down, just like I showed you on the TLT, right, they cut the interest rate. So when interest rates go down, that works inversely to the price of a bond, so the price will go up. So tomorrow, these will be the three things I'll be watching. I'll be watching the TLT, I'll be watching the gold, and I'll be watching SLV. But I won't be initiating any new positions going into this decision. I'd rather stay on the sideline. Just remember, guys, no position is a position, or cash, staying in cash is a position.